Hey everyone, welcome back to Corporate Decoder. Today, LWAY just filed an 8K reporting the redemption of shareholder rights, and I see a subtle shift that might hint at future moves. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details the company ending its shareholder rights plan, and it could signal a move towards simplifying their capital structure or preparing for something bigger down the road. Alright, let's dive into what Lifeway Foods Incorporated, or LWAY, has just filed. This isn't a big financial report like a 10K or a 10Q. Instead, it's an 8K, which is for reporting major events that shareholders should know about right away. The main event here is that the board of directors on June 5th, 2026 decided to redeem, meaning they are calling back and effectively cancelling the preferred share purchase rights. These are often called poison pills and are usually put in place to prevent a hostile takeover. These rights were issued under something called a shareholder rights agreement, established back in November of 2024 and then amended in October of 2025. Lifeway has partnered with Computershare Trust Company, NI as their rights agent, to handle this redemption. So what does this really mean for shareholders? It means these rights, these potential protections against unwanted takeovers, will simply terminate. The only thing holders of these rights will be entitled to is a very small amount of money, specifically $0.001 or 1/10 of a cent, for each right they hold. That's practically nothing, and with that, the entire rights agreement will no longer be in effect. Now, why would a company decide to get rid of its poison pill? There can be a few reasons. One common reason is that the company management and board feel the company is no longer under threat of a hostile takeover. They might believe their stock price fairly reflects its value, or that the current market conditions don't pose a significant risk. Another possibility, and this is where it gets more interesting, is that the company might be planning a significant strategic move. This could be a merger, an acquisition, or even a substantial change in its own capital structure. By removing the poison pill, they make these kinds of actions easier to execute without triggering the anti-takeover provisions. Looking at Lifeway Foods' market position, they are in the consumer defensive sector, specifically packaged foods. They have a market cap of about $364 million, a PE ratio of 24.8, and their stock is currently trading around $23.50. They have a relatively modest number of employees at 293. We also see recent news from the 5th of June 2026, confirming this redemption with headlines emphasizing the nominal price of $0.001. This confirms that the market is noting this event, and it's being reported as the ending of the plan. When we look at their top institutional holders, Divisadero Street Capital Management holds a significant 9.2% stake, and Crescent Asset Management has 3.3%. These are substantial shareholders, and their perspectives on the company's strategy are always important. The removal of a poison pill can sometimes be seen as a signal of confidence from management in the company's future prospects, or as an openness to strategic alternatives. Lifeway Foods is incorporated in Illinois. This filing itself doesn't give us deep financial numbers as it is focused on a corporate governance event. However, the timing of this cancellation is interesting. Often, companies will remove these protections when they feel they have a clear path forward, or perhaps when they are initiating a new chapter. Given the company's market position and the fact that it is in a generally stable consumer sector, this move could be more about streamlining operations or preparing for growth rather than reacting to immediate takeover threats. The company does have its common stock trading on the Nasdaq stock market under the ticker LWAY and also preferred stock purchase rights. The fact that they are registering these on a major exchange highlights their status as a public company subject to these kinds of disclosures. This filing falls under Item 1.02, which covers the termination of a material definitive agreement. In this case, the material definitive agreement is the shareholder rights agreement itself. The termination of such an agreement is considered significant enough to warrant an immediate 8K filing. It's also cross-referenced under Item 3.03, which deals with material modifications to the rights of security holders. By cancelling the rights plan, they are indeed materially changing the rights associated with holding the company's shares, especially in the context of potential corporate actions like takeovers. So, what is the story here? Lifeway Foods is essentially removing a layer of defense. This is a pretty standard move for a company that feels secure or is planning something significant. It is not necessarily a cause for alarm, but it is a signal that the board is actively managing the company's structure and potential future. For investors, it's worth keeping an eye on any further announcements from Lifeway. This move could be a preamble to other strategic developments. The risk I am watching is what this might enable. Will it lead to a beneficial acquisition or a more aggressive capital restructure that could dilute existing shareholders? Only time will tell. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe. And join our Discord community linked in the description.